Hey, thank you for watching this video today. I put together this PDF case study, and I just wanted to walk through and talk through it and just share how we have helped security companies in the past. I wasn't planning on doing this today, but I was excited to do it. So I'm just going to walk you through this document, and hopefully you can see how what the financial levers are that are common for security guard businesses. So we started working with a security guard business that um, when we started working was less than 10 million, closer to $5 million in revenue. And less than 3 years later was over $30 million of revenue, eventually got above 40, close to 50. But when we came to them, the stress of the rapid growth was adding up. So this company or this case study is about that company and how we help that company and make those transformations quickly. So I'm just going to walk you through this. Um, this company focused on oil and gas security, museum, HOAs, roving security, construction, guardhouses, high rise commercial security. So they had a broad spectrum, even did some government stuff of all different types of security guards, all different types of posts, even including some vehicle complexities as well. They were growing rapidly because they were taking on new contracts and taking on contracts in new industries where they were seeing a lot of traction and in turn saw really quick growth in those industries. The problem is because security is a tight margin business, that growth was putting stress on the business. They were getting these contracts, but they weren't always doing a good job of figuring out what their actual profitability was. So profits were shrinking, but the fast growth and slow turnaround on cash meant that cash was constantly tight. And it always felt like, in their words, that they were always running out of money. So when we did our initial assessment of them, they had almost no cash in the bank. They had large amounts of unpaid accounts receivable where they'd not been calling or collecting on. These were over 60 and 90 days old, and a significant chunk of their accounts receivable was in that bucket. They had a line of credit that was just a baseline line of credit that you can get from a large national bank, had no special details based off of their business. They had a really slow invoicing cycle. They were not invoicing until the 15th day of the next month. So if work was done on the first, they were taking 45 days to invoice that out. And then they had unprofitable jobs because, again, they weren't quoting stuff correctly. And then they had overtime issues, not only issues of scheduling, but clients requesting stuff at the last minute, forcing them into overtime, uh, and then them or the company having to eat that cost. So while all looks outside and inside the business, if you didn't understand the financials, you'd think these guys are killing it. They're crushing it. They are super successful. They're flowing in money and they have a really, really bright future. But when it came down to it, every single payroll, they were wondering where the money was going to come from. So, as we talked to leadership and examined the financials, there were two immediate priorities that we saw. The first one is we wanted to make sure that we improve their cash position, and we did it quickly, because if we didn't, that continued growth was going to mean that they potentially did come to that into that runway where they had payroll come up and they didn't have the cash for payroll. The second one is we needed to increase profit margins. And this was a more long-term project, but there were immediate things that could be done to provide some initial relief that would help them get a little bit more cash in the door and, again, help that cash position as well. So I'm going to walk you through the things that we implemented. The first steps we took were trying to improve their cash position. So what we did, three things up front, is we started collecting accounts receivable immediately, getting on calls, talking to the people, that were the contacts with those accounts, even escalating up to other people in the organization and saying, hey, we need this money. Why do we not have it? And eventually, we were able to start getting that money in. Some of those first calls, sometimes people just didn't even know that it was outstanding. They'd forgotten about it. Emails were going to spam. They never called them. They never even reached out in some cases. And so even just that little reach out meant more money in the door. There were also some broken processes. We weren't able to fix those immediately because that would take some time, but we were able to identify those and create plans for fixing them, because those were often bigger companies that had a lot of money outstanding. And so if they're even going over the term, say 30 days, then it puts pressure on that business. Next, we had to rethink the invoicing process. So I mentioned if work was done on the 1st or say even the 15th, they were not invoicing it for 30 days or until the 15th of the next month. So 30 days or 45 days, up to 45 days after. And then they were taking another 30 days to pay because their default term was 30 days. And that was if they paid on time. So if work was done on the 1st, wasn't invoiced till the 15th of the next month, that's 45 days lag. Then another 30 days is 75 days before you get that money in. The problem is if you're paying people biweekly or say twice a month, that 75 days means that you have, let's just assume you pay on the 15th and the 30th. You have the 15th, 30th, and the next 15th, 3 payrolls before you do an invoice. And then you have the 30th and the 15th. So you have 5 total payrolls before you get paid. And if they even pay 2 days late, you have a 6th payroll. And so that puts a ton of cash strain on the business. So what we did is we looked at redoing the invoicing cycles. Some we were able to get to where we're invoicing more frequently, invoicing at the end of the job. When you invoice at the end of the job, that also helped with collection of AR because it was more fresh when they received the invoice. For the ongoing jobs, we look for ways to speed up that invoicing. I'll talk a little bit more about that here in a second. The third thing we did was we talked to the bank about the line of credit. And a lot of people, they go to their bank, it's just the bank they've always known. They talk to them about, hey, can I get a line of credit? They'll give them a line of credit, but they don't have any special provisions. Or that bank may not even be super familiar with the type of business. And so one of the things that you can do is go to a bank that's familiar with your type of business. So there's banks that are heavy in real estate. There's banks that are heavy in businesses. If you're at a real estate bank and they're trying to do a business line of credit, that may not fit their ideal customer base. And so you're probably going to have more restrictions. But if you find that right bank, they'll often give you a higher limit, allow you to increase that limit more quickly. And then they will even allow for customer concentrations or reduction of the overall covenants that you may have. And so what we were able to do with this business is we were able to increase the concentration limits on a customer basis that they had based off the strength of those customers. And we were able to increase the overall limit and even go back for additional increases. We did that by pitting a couple different banks against each other, reevaluating those relationships, finding a bank that fit us a little bit better. So we can go through all these details. You can read this and see all these additional details. The one thing I want to mention on that I didn't mention before on the rethinking the invoicing process is we put it into 2 different buckets. The ongoing jobs, we build those twice a month, 10 days after the period, and then the temporary jobs that were billed immediately. The second piece of that is that the schedulers were inconsistent about entering their schedules into the system. And I see a lot of businesses that are just using old and default, um, software or solutions that they use just because they started with it and they've not updated anything. And that was the same case for these. And we were able to help them find a right software solution that made entering these schedules significantly easier. So we spoke to those schedulers. We found that there was a lot of friction. So we started exploring ways to implement new scheduling software. When we implemented this new scheduling software, the business was able to transition to a weekly schedule confirmation. So, meaning schedulers were entering the schedule into the system in advance. Then, after the time was worked, they were confirming it within the first 3 days of the next week. And that meant that theoretically, after the end of a month, um, if that month ended on a Saturday, you could be ready to invoice within 3 days. We still kept it on a 10-day cycle to give a little bit of buffer so that invoices weren't coming out at inconsistent times. But that was a huge transition for the business. But it improved not only the accounting side of things, it improved the scheduler's life and improved the employee's life. Because before, schedulers were just had makeshift systems where they were sending out the schedule. And so oftentimes employees would miss what that was sent. They'd have text messages only and just like all these weird systems and ways. And so this standardized that system. So not only um, did it improve the invoicing cycle, it improved the AR cycle because when you invoice more quickly after, you get paid more quickly often because there's less questions about the invoice. And then it also improved the life of the schedulers, of the managers over the schedulers, and improved the life of those employees. So huge improvement for the business, and meant that overall they were getting the money to hit the bank account 20 to 50 days sooner. If you think about that, that compounds and the fact that now they can grow more quickly. And previously, they were limited in the growth that they could have because, again, it was taking sometimes up to 75 days to get that cash or more. And now, when you finish that job or you invoice within 10 days of the end of the period or 10 days after the 15th, you've now reduced that cycle substantially. And so that is something that can really transform a business that is tight margin like this. So if you look at the three results from this cash, is first, they took their average days to pay from 61 days to 43 days as we tracked down that overdue accounts receivable and put in policies to do better with that. We were able to help by in tightening the billing cycle, help money hit their bank 20 to 50 days faster, depending on the contract. And then when we renegotiated that line of credit, we were able to fund 20% month over month growth overnight. After we did those initial things, again, we were able to do those in a very short period of time. We looked at increasing their profitability. And again, if their profitability was 8 to 10%, that means that's every month 10% of that revenue is going into cash. It's increasing that cash balance. But when that profitability goes all the way down to 3%, you now have significantly less cash being generated. So the way that we did this is we built a bidding and pricing engine that worked for them. It took in all the variables and made sure that they had confidence about what they're bidding on. Not only did this help them increase profitability, but in situations where there were big jobs, where there were big opportunities, it allowed them to go in with more confidence, which meant that before they may have added a bunch of padding, now they could actually be lower on their price because they were confident that with that tool that they were able to actually know what their real costs were. This gave the leadership clarity and helped, and ultimately meant that a little bit after this, they were able to bid on an $8 million a year contract with a lot of complexity. The model really helped them with that. And 3 years after that contract, they came in within 1.5% of the original profitability and revenue estimates. That is huge. That level of certainty meant that they were able to put their best foot forward with that bidding process, and that was likely against much larger competitors what allowed them to be able to gain and win that contract. And we know for a fact they weren't the lowest, but they also weren't the highest. They were in that really good middle spot, that they were able to communicate that they were a top tier product, but they were able to give that at a value. So that was great and something that completely transformed the business. The next one is work on the overtime problem. So that new software helped with the overtime problem because there was more consistency for the schedulers. They had a better sense of the overall picture. They set up a system that identified client requested overtime, so they're able to label that in the schedule. And then when it went to billing, they were able to bill for it where the contract allowed for it. And then this also added clarity of what was client related and what was scheduled overtime. And so they're able to work with schedulers and say, hey, you should not be scheduling overtime like this. Is this because of a call off or is this because you scheduled it? And too often it was found that they scheduled it. It allowed for those managers to address those schedulers and work on those problems. Part of that set up an incentive structure for the schedulers to reduce overtime, and then gave better with that software, gave better reporting to the managers to know how to have those conversations. With doing that, non-client covered overtime was reduced by over 50%. If you think about that, that's all money that was lost that is now just dropping down to profit and increasing profit. Then we do this with every business, but security is tough, low margin, cash tightness. We were able to come in and really implement some really good reporting and forecasting tools that gave that business and those leaders insight into what was going on in the business. So 3 years later, the owner went from having to put cash into the business because of the tightness and the growth to being able to take a monthly owner's draw. Summarize, net profits increased from 3 to over 9%, gross margins improved by more than 15%, doubled line of credit availability, improving liquidity and capacity to scale, 43-day improvement in the cash conversion cycle, tighter billing, and 25 to 50-day improvement there. Reduced overtime by 54%, and then better scheduling, less administrative bloat. And then again, won this $8 million contract and won other contracts as well that were highly competitive bids that before would have been just a guess on whether they were actually going to be profitable. Their team described Bison CFO as the most unshakable partner into the room, able to take complex problem and turn them into decisions fast, getting them information at their fingertips to allow them to act nimbly and move quickly in their business. If you run a security guard firm and you're struggling to make payroll, you're wondering where your cash is, you're struggling with profitability, we would love to help you. I recorded this just to walk through this. If you go down below, you have a link where you can put in your email and you can get this report. And I love to have those conversations and talk about ways that we can help your business as well. So go down, fill out that form, schedule a call. Can't wait to talk to you. And until we do, best of luck as you continue to grow your security guard business.